Today I'll be talking about what percentage of assets do we allocate into a cryptocurrency, specifically a stablecoin portfolio. Hello, my name is Chris. I am the instructor for the Cryptocurrency for Conservative Investors program under Dr. Wealth. And let's get into our discussion. The main gist of our discussion is to answer the question as to how much would be a safe allocation into cryptocurrency. All right, and I'll be going through the 90-10 rule, okay? And briefly, I will run through how a structure of a traditional portfolio were to look like. Right, we need to understand what a traditional portfolio is before we talk about what a stablecoin portfolio should look like. Okay, and then after that, we will dive into what are the rookie moves a conservative investor can make in the realm of cryptocurrencies. Okay, and finally, we will discuss what a fair allocation is between these two major asset classes. All right, what I'm going to do now is that I'm going to talk about the 90-10 rule. And this is going to apply in various and multiple cases throughout our presentation today, right? And the idea of the 90-10 rule is very simple, right? Whenever we're trying to build or allocate something, 90% of whatever we're trying to do should be placed in traditional or stable kind of assets. And that gives room for us to be a lot more adventurous and to take on a lot more risk with our remaining 10%. All right, so this way we have a balance of a conservative, stable kind of portfolio most of the time, but we would still have a little bit of excitement and upside for the rest of our portfolio. Okay, now let me begin by talking about what a traditional portfolio is, right? The traditional portfolio basically means all the asset classes that we've had prior to cryptocurrency. Okay, and one way of thinking about what a traditional portfolio is that it's divided into four parts. All right, the first being stocks or equities, right? So DBS, OCBC, UOB would fall into this category of stocks, right? The second category would be real estate, and that's where your Ascendas REITs, your Mapletree Industrial REITs will fall into the second category. And these assets basically allow us to own buildings, all right? Now, the third category are bonds of fixed income, and this is, for example, our Astria 4, 5, and 6 private equity bonds would fall into this category, and bonds actually give us a very stable kind of coupon flow. Okay, and finally, commodities, and commodities is basically raw material inputs into the various industries. All right, so if you were to perform an asset allocation among these four asset classes, even if you have done it evenly 25% each, you would end up with a portfolio that wouldn't do all that badly out there. Okay, so that's what I mean by a traditional portfolio. Okay, and what is the opposite of that? Now, the opposite of a traditional portfolio is therefore the stablecoin portfolio. Okay, and the stablecoin portfolio should consist largely of stable coins like USD Terra, USD Tether coin, as well as USDC coin. These are stable coins that are pegged 1-to-1 against the US dollar, and so they hardly fluctuate on a day-by-day basis. Now, the strength of being able to get into these stablecoin markets is that you find various decentralized finance platforms that can give you a very decent dividend for the amount of investments that you put in. Like, for example, the Anchor protocol currently still provides a yield of approximately 19.5%, even though it's expected to go down over time. These yields are still fantastic, right, compared to traditional instruments. Hodl will accept your stable coins and give up to 9%, right? Crypto.com, they've recently lowered their yields to about 6% lately, and we still have centralized exchanges like Tokenize that will provide 9%, right? So if you were to allocate your money into stable coins for the cryptocurrency component of the portfolio, you wouldn't really do all that badly, and it's actually relatively stable on an ongoing basis, all right? And within this stable coin portfolio that is meant to be about 10% of your overall portfolio, we then drill in and allocate 90% of it into traditional stable coins, right? Okay, and that will give us a blended yield of around 10%, all right, 10% dividend yield. Now, what happens to the remaining 10% within the stablecoin portfolio? Now, you can be extremely adventurous, because if you think about it, right, your traditional portfolio takes up 90% of your portfolio. 10% of your portfolio is invested in stable coins, and within this 10%, we take 10% of that and we can do something really fun with it. Okay, and that is only 1% of your overall portfolio. So you can really knock yourself out and do something crazy with that amount of money that you have, right? And I think nothing can be crazier than the idea of doing liquidity mining. Now you see there are various websites or decentralized finance projects where investors are encouraged to put your money to provide liquidity to other people, right? So you're putting your coins into a pool. Other people are actually buying and selling from that pool of cryptocurrencies that you put in, okay? And you are paid a certain amount for running an exchange, okay? So if you're willing to do this with your funds, the kind of yields that you get is astronomical. Like for example, the Nexus protocol, some of the liquidity mining pools can give 70 to 110% every year. The Mirror protocol that allows you to actually synthetically build stocks, right? Like a mirrored version of Microsoft stock. If you were to apply some of these strategies into the Mirror protocol, you get 25 to 30% a year. And the newer and the more obscure decentralized finance projects like Astroport could pay 100 to 150% a year. Now, this is an extremely risky kind of allocation, okay? But within the short term, right, it will generate a lot of tokens per unit time, okay? But you're also facing a lot of market volatility, and you also run this special form of risk called impermanent loss, right? But because we're only putting 1% of our funds into liquidity mining, it's actually money that we can afford to lose, given that the rest of the 99% of your portfolio will be generating income for you. Okay, yeah, and so this is how the allocation looks like. 90% at yields at around 10% APR into stable coins, 10% into liquidity mining pools that can even achieve up to 100% APR. Now, if you do this overall, you might be able to achieve approximately 18 to 19% yield on your stablecoin portfolio, right? Which makes it really, really fun and makes it very, very rewarding. Okay? All right, now what I'm going to do is that I'm going to focus my discussion on the mathematical effects of introducing 10% of your portfolio into stablecoins. All right. Now, in order to do that, I will have to walk you guys through a more conventional portfolio that consists of 50% stocks and 50% bonds. We do this so that our analysis can become a lot simpler. And with this example where there are two ETFs, 50% stocks and 50% bonds, we've backtested the returns to give 9% with a standard deviation of 12%. All right. So basically what we're trying to do is that we're taking a very, very boring, very conventional kind of portfolio, okay? And we want to see what happens over time when we simulate 100 or 200 retiree portfolios, all right? So using a computer, we take 9% return and 12% risk. We simulate, for example, 500 retirement portfolios. And when we do this, we are able to get a failure rate of 13%. In other words, when everybody were to attempt retirement, not everybody succeeds, all right? So in this very conventional case, about 13% of the people that attempt retirement using this conventional 2 ETF portfolio basically fail, right? When you fail, it doesn't mean that you die homeless on the streets. It means that you might have to work until much later in life, or you have to rely on your children to be able to survive. All right, so that is the conventional retirement kind of simulation that we have. So what we're going to do now is that we're going to take this very, very simple portfolio and we're going to add 10% of stable coins into this mix. And what we're going to do is that for this 10% of stable coins, we're going to apply a very conservative assumption as to what the returns are. We're going to just assume that it gives you 12% every year, right? Which is much lower than what we can actually get in practice, as I've explained some time ago, right? So with this allocation, right, what is going to happen is that this stablecoin portfolio is going to raise our returns, right, from 9% to 9.3%, all right? And it's going to do, the other thing is going to lower the risk of your portfolio because it's very stable. The risk of your portfolio goes down from 12% to 10.8%. Okay, so increase in returns and a reduction in risk. And so now what we can do is that we can simulate the retirement portfolios and we run the exercise again, right, with a higher return and a lower risk. And we find that a 10% allocation to stable coins can reduce the failure rate of a retirement portfolio by 38%, right? So you're making a tiny, very subtle change to the way you allocate your assets, and you find that adding cryptocurrencies and stablecoins in your portfolio actually allows you a higher probability of successful retirement. All right, and so that basically ends the bulk of my presentation today. In summary, now applying this 90-10 rule can be a very effective means of deciding how much cryptocurrency to add to a portfolio. All right, always try to be conservative and safe. Keep 90% in traditional assets like stocks, bonds, real estate, and commodities, and then allocate 10% in stablecoin yield farming. That gives you about 10%. Within this 10% of stablecoins, you can take 10% and really go crazy with this amount of money. And what I really love about the cryptocurrency world is that there is this class of extremely volatile instruments called liquidity mining, where you could get yields of 100% or 150%. Because it is 1% of your money, go ahead and knock yourselves out. All right, it is money that you can definitely afford to lose. Right, now just make sure that in the event that cryptocurrency strategies are unsustainable, you will still be able to come out ahead from your stablecoin use as well as your traditional instruments. All right, and this, I think, is a very good framework on how conservative investors can bring cryptocurrency strategies into the fold. That's all I have for you. Thank you very much.